We'll start today with Aussie Dollar, and as usual we'll take the weekly outlook to see if we have the right Fibonacci outlook. We have the Fibonacci outlook that we have drawn already weeks ago, and it's the same wave that's holding on so far. Yesterday the pair pretty much tested the 200 level almost. This I don't really use the 200, but nonetheless, sorry, I mean the last week it has tested the 200 level more or less, and now we are looking for the pair overall to break or to reverse from the 50-day moving average. That being said, on daily time frame, both of our moving averages are showing down. Only our MACD is above the zero line, so there is a little on daily time frame. There is a little confusion in the market, but the main trend following indicators that we have are the moving averages, and they are in favor of the bearishness, which is also supported by our Fibonacci outlook. You could also draw a small trend line over here that you would see that it's going to be holding on pretty well. I would draw it like that, and that's the main thing that we are looking at. So we have a higher cap on daily time frame, which makes us expect to see the further continuation on the bearish market movement. Meanwhile, on daily time frame, if we look at it, we can see that moving averages are showing a little upwards. Zooming out, we can see that it is actually moving relatively sideways between the trend line and, of course, the 138.2% Fibonacci retracement zone. As we discussed before, I am actually in person in favor of bullishness for this pair, and I believe that the trend line is going to be broken upwards. So therefore, I'm expecting to see a buy opportunity once again from 0.6990 level or 0.70 level, which means that with the possible break below of the yesterday's lowest low, we can expect to see another 80 pips further downside development. But once again, I won't be trading today, and I wouldn't really trade that sell order neither, for the fact that we have a major support level. Basically, this is the level that we are looking at, and you can see how many candles was tested and reversed backwards at that level. So it's a very strong support level that we are looking at. So the preference for this pair for now stands at buy opportunities close to 0.70 level, which we are going to be looking into furthermore for confirmation on Monday. Next pair that we are going to be analyzing is GBPUSD. We said at the beginning of the week that the pair is within a triangle formation, and we were looking for the pair to break above or below the triangle. On daily time frame, we can see this triangle a little better, and it has already been tested and it has already been broken below. The next resistance or support that we are looking for is over here. So the smaller one has been tested as we expected. We were aiming the 100% Fibonacci retracement zone, which was at 0.4240 level, and it was tested already this week on Wednesday. From here onwards, we have basically two things to look for, and we can see it a little clearly on hourly time frame. First thing that we will be seeing is the fact that the next trend line that I've just drawn will act as a strong resistance level, which was later on supposed to be to turn into a support level. So we will be putting actual buy limit order for this pair. Technically, completely at 1.4180 level, which is approximately 150 pips from where we are right now. And you can also expect to short the pair whenever you see that the momentum is increasing. I wouldn't be able to give you the right entry level just as a pending buy stop sell stop order, for the fact that we have this level as a strong support level. So when you see that the momentum is increasing, my preferable entry level would be just below the 1.4290 level, so that we have the confirmation that 1.43 is broken below. So in that case, we could be considering further sell orders as well towards 1.4180 level. However, additionally, as we can see, the pair has found itself a support level on this level, and it is making relatively higher high and higher low. So if we consider the current this low that I'm looking from Wednesday as a low, Wednesday's high over here, yesterday's low was higher than Wednesday's low, and of course yesterday's high was also higher than Wednesday's high. So we have a price formation that is pushing a little upwards. So far today's low is also higher than yesterday's low. That means that there is a possibility for us to look also on a bearish formation as well. If that is the case, you should be looking for possible buy opportunities. Once again, I repeat, possible buy opportunities at 1.4350 level. And your initial target, of course, should be 40 pips just on yesterday's highest high, which is going to be also the 200-hour simple moving average. And from there onwards, final target should remain at 1.4490 level, and it's going to be in total 160 pips potential opportunity out there. On euro dollar, we saw the pair attempting to break below our previously set support level, which was at 1.11. It was yesterday. The pair went below that level approximately 30 pips, but couldn't sustain itself and continued its sideways range development once again. If we go ahead and once again draw a trend line over here, correct one like this, we will see that the pair is moving on a dynamic resistance as well with the trend line. And of course, the pressure is from the top to bottom. At the moment, my preference, because of yesterday's fake breakout, my preference stands at bullishness of bullish correction of the market. And we can see it clearly on daily time frame. If you look at yesterday's candlestick, you will see that we have had basically two of the candlesticks previously, Tuesdays and Wednesdays, as a continuation candlestick formation. That's why each day we had market continuation. Meanwhile, yesterday's candle was a reversal candlestick formation. So that's on the daily time frame. So if we look at it clearly, we will see that there is a possibility for the pair to go on bullish side, and I would look for today's highest high to be penetrated above, basically a break above 1.1135 level, and from there onwards we could be basically aiming to make 36 pips towards 1.1170. Then you can also aim to 1.12 level, which is going to be 200-hour moving average. And finally, we, as a main final exit, we should be aiming to have a 1.1357. However, you need to make sure that the 1.1237 level is broken above, as it is our side range development level that we have had so far for the last couple of weeks. Moving on to gold, as per your request, let's take a look at it on daily time frame first. We can see that gold has reversed initially from 200% Fibonacci retracement zone and found itself as support at 138.2% Fibonacci retracement zone. And yesterday we were discussing that if you see the pair break above the $1,207 per ounce level, our initial target was remaining at 1,222. Now moving on to hourly time frame to show you why that level was important. We analyzed the market at 10 o'clock, of course, as usual. The reason why we were looking at 1,207 level was for the fact that the candlestick formation that we were having in front of us was a reversal candlestick formation the previous hour. This one, 9 o'clock. So whenever this happens, and we saw that the market was making actually a higher high and higher low, this high, then we had a higher high, higher low, higher high, then somewhere middle high, and the following high was higher as well. So we saw the price action formation, and also we saw the market breaking above the moving averages, while both of our trend following indicators, which are our moving averages, were sloping upwards. So that being said, this was the main reason for us to consider to go bullish above the 1,207 level. Now, what could we expect from gold? This is, I guess, what puzzles you. As we are looking at the valuable metal, we can see that it has broken above the level, and the next support that we have is more or less at 1,217.16 level, and any correction that we would have would be temporary. So you can go ahead and place a Fibonacci just from highest high of yesterday to the lowest low, and you will see that 38.2% falls onto also 1,216 level. So you should be aiming, if you are shorting the pair, you should be aiming to exit this position, your short position on gold at 1,216, and look for long opportunities from 1,214 level. So you have approximately $9 per ounce drop opportunity there as well. We'll analyze freshly a new currency pair as per your request today. This is the New Zealand dollar, Japanese yen. Since I haven't analyzed it yet, I need to count the candles to find the correct Fibonacci retracement zone. So give me just a second. We have our perfect Fibonacci wave over here. We basically are combining the first 2 weekly candles of January 2016. And the way I basically can see that it is the perfect Fibonacci retracement zone is that it needs to behave on 38.2% or 61.8%. And we can see that the pair basically reversed right on the 38.2%. So we have the confirmation on that level. And from there onwards, we can also see that it also obeyed the 61.8%. So it's a perfect Fibonacci wave that we are looking for, or true Fibonacci wave. First thing that catches my attention right away is that we have a support line over here, which is at 74.50 level approximately. And I can tell you right away that if we see a break below that level, for the fact that we have seen a reversal from 38.2%, if we see a break below from that level, we will be looking for 138.2% immediately. So it's going to be approximately 200 pips potential drop, but of course it's not going to happen over a day. So let's move on hourly time frame to be able to catch that level better and see what other structural development we could have for ourselves. The first thing that I see on this pair, let me zoom out. The first thing that I see on this pair is the following divergence. We have a divergence while the market is making a low. Over here, we have had a bullish development or a bullish divergence on MACD. It's not something that I really like entering, but it is an overall structural development that we cannot really rule out. So what I would be considering right now would be that the pair is likely to move a little upwards, and we could consider to sell either from 75.20 level or so, to be more precise, 75.30 level. And it's going to be basically the intersection of the two moving averages we have. Use a tight if you're going to be, I don't generally trade this pair, so again, it's the first time that I'm analyzing for you here. So if you are going to be trading the pair, use a tight stop loss. Don't go for a big one. 30-35 pips stop loss will be, even 40 maximum will be enough. So take that opportunity to sell from 75.30 level, and your first target will of course be 74.55. Second target will be 73.80, and final target that you need to exit will be 71.69 level. And you can also alternatively put a buy order and just leave it the way it is. You can put a buy limit order at 71.69. I can already give you almost a guarantee that you're going to be making at least 40 pips profit whenever that level is hit. So you can just put it there, forget about it. Whenever it touches, and you will be ending up with a profit. Last thing that I'm going to be looking at today is going to be the crude oil. You go on daily time frame just to have a look at it, hourly, and we can basically see what we really can expect from this. So crude oil yesterday moved upwards and downwards, and overall, I think this is the expired one. 1 second. So back to crude oil, we can see that yesterday, as we were analyzing the market live with you, we discussed that there is a likelihood of the market to be on a bullish run. Initially, we were looking for a bullish breakout, which did happen. However, it was not a long-lived one, and from there onwards, the crude prices tumbled back to $32.50 level. At the moment, we have quite few confusion in the market for the fact that we see, as we were discussing yesterday about the fundamentals of the crude, we see that Iran backing up the data or backing up the conversations that there should be regulations and there should be some kind of collaboration between oil producing countries all over the world. But on the other side, there is literally no change in the oil production in the world, whereas the oil consumer demand is falling for the fact that we are entering into another financial crisis. So at this given moment, the market is quite confusing for crude oil, and we can see that it's a sideways development. And based on this, basically, we could just say that sell from 35.55 level and buy from 26 level or so. This is a different. This is the U.S. oil contracts for April, so it might look a little different because I missed the the expiry date of the contracts for yesterday. So this is it so far, and it's time for us to have the questions and answers now. Any reason why you don't trade on Fridays? Historically, Rustam, I sustained most of my losses on Fridays. That's the main reason I don't trade, or I don't want to trade Fridays. And on the other side, if you are a successful trader and you know that the market trades best and trends best on Tuesday, Wednesday, Thursday, so you can take advantage of Tuesday, Wednesday, Thursday, basically work for 3 days and take the days off, spend some time with your family, etc. on Fridays. That's what I would do and what I do most of the time. So mostly Fridays are either no working day for me, or it's just half day. We have another question over here. Why do I have MACD on my charts, but you never mention them? It's just for my eye. I look at it in two ways. If the MACD is below the zero line, I see the market to be bearish. And if the MACD is above the zero line, I see the market bullish. So it is another trend confirmation for me. It's also a type of, it's based on moving averages as well, because I rely pretty much 99% on moving average and Fibonacci overall. So that's the main reason. When will we have Fibonacci training technique? I have it on my agenda for March, and we will publish it on a2zforex.com in the coming days when it will be posted. Which time frames are the free signals based on? Unfortunately, I am not providing signals. The signals provided on A2Z Forex is provided by our team member and the chief currency strategist, Yuri Safranau. I'm right now in Lithuania, and I met Yuri yesterday. He traveled here as well. And we have agreed yesterday that he's going to be hosting webinars with us from next week onwards. So you can ask this question to him, because he's the one providing the signals, and I don't know the details that he's using. What's your general guideline on stop loss when trading gold or oil? Overall, gold and oil is not something that you can just say, I'm going to use 35 pips or $3 or whatever, and it's going to be my stop loss. For those commodities, you need to define the resistance and support levels. Just like the entry that we took above 1,196, if I'm not mistaken, it was. If you look at it, we missed literally the stop loss by 10 or 15 pips difference, if you can put it on pips, basically 1.5 or $1 difference. And the reason why it was so precise was because of the fact that we basically took the support when we were buying, and we deducted also another 2 pips of it. So when the market was tested on the support, we were still confident, because we still had 2 pips of differentiation on it. So define your support resistance. If you are buying, put your stop loss at least, if it is on gold, put your stop loss at least $2 below the support. If you are selling, put your stop loss at least $2 above the resistance. On oil, again, you define your support resistance levels, and you basically need to use 10-cent differentiation, 10 to 15 cents. If you are buying, put 10 cents below the support. If you are selling, put 10 cents above the support. Of course, involve your spread as well. I will ignore Fibonacci related questions, and we will cover it in our Fibonacci related activities in the coming days. How do we measure or calculate pips to target with a trade? Basically, I have two ways of targeting my take profit. Of course, everything I do in life involves measurements. Okay, I calculate the number of hours I sleep. I calculate when I'm gonna have my lunch. I calculate when I'm gonna wake up. So everything that I have involves basically calculation. Basically, I try to put everything in routine so that I don't take unnecessary, irrelevant decisions. The same, I believe, could be applied in financial markets. So let's just take a look at the markets, and I'm going to share something with you. Let's say gold as an example. Whenever you are taking the market into consideration, first of all, you need to understand approximately how many pips does the market move per day. So for gold, we know that on average, gold moves 200 pips a day, correct? So this is what you could do. As an example over here, you see that yesterday the pair first gold first dipped by 93 pips. So we were looking for the pair to break above the 1207 level. So that makes 59 pips. Let's say 60 pips. So from here, 60 pips and 200 pips minus 60, it makes basically 140 pips. You could just target 140 pips, approximately somewhere here. Well, if you are very precise, you will see that it is just the highest high of this candle. So there it is, more or less. So if you look at it properly, we basically are aiming to follow the market to its final breath. Additionally, of course, I use Fibonacci. Yeah. So what other thing we could do, or what other thing we could have done, and for it we need to go on the daily time frame. So this is what really also happens. The market moves on attempts, like as an example here. These attempts are of course called as waves. That's why I analyze most of my developments on the weekly time frames, because the weekly time frame shows us the correct waves that we can aim for. And the following is what generally happens. I'm going to have to delete my waves so that we can just share it up. So let's imagine that this is the wave that we want to have. And indeed, this is also a wave. We can't say that it's a fake wave. Basically, whenever the market moves on this, you basically catch highest high to lowest low of a wave. You can aim for 138.2%. From there, you can always short. Okay, let me just show you a couple of other examples. If you want to take this example here, over here, you can see that 138, okay, it was missed. 138 over here because I had two waves there. It was touched and it was reversed. The first one, you basically have at least 150 pips. Or let me just turn the little around, show you something else as well. So again, 138, turn around. So if you always try to find the market from the wave standpoint perspective, you can pretty much all the time expect the market to behave the 138.2%. This is, once again, we are going back to Fibonacci. So you need to always try to understand what is a wave made of. What can I consider as a wave that will tell me the following market developments? Because I'm still convinced that the market moves on mathematical calculations and the market moves on psychological developments. So the psychology, like a human psychology, is based on waves. The market is also based on waves. As long as you can try to understand and push yourself to understand those waves, you'll be able to catch the weekly waves. You also need to understand that weekly waves involve a little higher risk ratio for you, for the fact that, let's say, as an example over here, if you were to sell at 138.2% Fibonacci retracement zone, we had to use a stop loss of 140 pips. And the next question that I would expect from you is that where do I, if I'm selling, let's say, at 138.2%, what do I aim? What's my next target? Because that's the goal that pretty much all of us have in order to understand. So to answer that question, I'm just gonna basically put this here for you. And you can see that 138.2% Fibonacci generally targets, well, if you just go on a fake Fibonacci wave, generally targets 200%. So you sell it there and you target 100%. And you can have many similar examples of such caliber. Let me just show you more, and then we can finalize it here. So this is the wave, 138, 100%, and you can see that after the 100% was hit, it reversed back. Then over here, 138. Okay, it didn't touch the overall main target, but it's because it's not correct one. So 138, we see that the market reversed, and then whenever it touches the 100% over here, it takes another dip. So you need to really try with these waves as much as you can, and because it's on weekly time frame, it's not on hourly or daily time frame, you always involve a little higher risk. But of course, from 138, you are basically aiming 100%, which is, let's say in this case, 350 pips more or less, and your stop loss is basically at some pips below the 161.8%. So you still have more than 1-to-1 risk-reward ratio, which is also a healthy level that you can target. And additionally, you can also, with this way, follow the trend as well. So some people would basically look for going against the trend and buying at 138.2%. But what you could do would be looking for 100% to sell. Again, 238.2%. So you take your approach differently a little, and you make it for yourself. When you sell it at 100% and aim 138.2%, your risk becomes smaller and slimmer, for the fact that you are then following the trend. So this is how I define my targets. And final, last but not least, whatever stop loss I generally use, most of the time I will be using 1-to-1.5 risk-reward ratio. And 1-to-1.5 is basically defining my average daily true range, which is another webinar that I have promised to host in the coming days. Thank you very much for your time and for your questions. I already wish you a great weekend ahead, and stay tuned, because next week we have two main guest speakers. We have the A to Z Forex Chief Currency Strategist, Mr. Yuri Sofranau, with us next week, and we will also have Adamos Anastasides in the coming days as well. So stay tuned. Make sure to go ahead and check your broker as well on A to Z Forex directory. Make sure that your broker is one of the approved brokers. If they are not approved, it means your account is under danger, because we haven't really approved them, and maybe we haven't tested them, but there is a probability that we have tested and they have failed their test. So trade with the approved brokers only, and secure your account.